Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include, another day, some more news from Bill Pulte, my interview with Telhio Credit Union's Allie Hager on how independent mortgage banks and credit unions differ in serving today's borrowers, focusing on borrower sentiment around rates versus payments, strategies for building customer loyalty, and personal insights on professional growth and finding one's comfort zone. And in the capital markets, despite the end of the government shutdown, what Federal Reserve officials are saying about future rate cuts. In the mortgage industry, it's easy to assume everyone understands the process of pulling credit. After all, it's a standard part of origination. But many professionals, even those adjacent to lending, don't fully grasp the infrastructure, data flows, and participants involved in approving a new homeowner for a mortgage. Mortgage lenders choose TransUnion for their identity-focused, data-driven mortgage insights and solutions, enabling them to achieve more desirable lending outcomes in a volatile housing market. To learn more, visit transunion.com. I always wonder when I see two gas stations near each other in a small town if the owners agree on pricing. But when you're dealing with trillions of dollars of mortgages and millions of borrowers, well, that's a different scale. And the leader and boards of directors should be held responsible. Per the AP, a confidant of Bill Pulte, the Trump administration's top housing regulator, provided confidential mortgage pricing data from Fannie Mae to Freddie Mac, alarming senior officials of the government-backed lending giant who warned it could expose the company to claims it was colluding with a rival to fix mortgage rates. Many are saying that if Mr. Pulte and the Fannie and Freddie boards want to be relieved of their duties, they should have just resigned. And if nothing of consequence happens, what does that say about the housing finance system in the U.S.? It's certainly a big story, as is the news that Rice Park Capital Management, a Minneapolis-based private investment firm specializing in mortgage servicing rights, announced that it has acquired Charlotte's Rosegate Mortgage, a retail and consumer direct mortgage lender. Quote, this strategic acquisition expands Rice Park's capabilities across the mortgage value chain, supporting both MSR recapture and retention strategies while reinforcing its commitment to supporting originator partners. End quote. Rice Park and Rosegate initially partnered in October 2024 to provide financing solutions for borrowers within Rice Park's MSR portfolio, which includes approximately $61 billion in unpaid principal balance, serviced through its affiliate, Nexus Nova. Under the new structure, Rosegate and Nexus Nova are combined into a single operating entity within Rice Park's organizational structure. Rosegate will continue to operate under its existing brand, maintaining its headquarters in Charlotte, North Carolina, and expanding its consumer direct lending operations. Shifting gears slightly, Federal Reserve officials spent this week stressing caution, saying they can't commit to more rate cuts until they see the economic data that was delayed during the government shutdown. Several policymakers pointed out that inflation is still too high and that lowering rates too quickly could backfire, while others emphasize that the next move depends entirely on what upcoming reports show. Bonds have traded within a narrow, familiar range, awaiting the Bureau of Labor Statistics to release the September jobs numbers. Data that will matter, but is also somewhat outdated. Signs of financial strain are growing beneath the surface, too. Subprime auto loan delinquencies just hit a record high, suggesting lower-income households are feeling real pressure, even as overall consumer spending still looks healthy. For today's interview, I wanted to welcome to the show Telhio Credit Union's Allie Hager to discuss how independent mortgage banks and credit unions differ in serving today's borrowers, focusing on borrower sentiment around rates versus payments, strategies for building customer loyalty, and personal insights on professional growth and finding one's comfort zone. She's a mortgage loan officer at Telhio Credit Union, and with over a decade of experience in mortgage lending, she's been helping individuals and families achieve homeownership since 2011.
Let's get into your journey. So how you started in the industry and how you got to where you are today. Before I ask any questions about IMBs versus credit unions, let's start there.
Okay. All right. I love that. I started in mortgage lending in 2011, and that was at a big bank. And so I did that for like 8 years. And then I switched over to my first IMB for about 10 months. Got to Telhio Credit Union. So I was at Telhio for roughly 4 years. And then I left to go to another big bank and then another IMB in a 2-year period. Just based on conversation and thinking that it was going to be the cream of the crop, like less work, more money, all the things that they talk about. And then quickly realized that I do my best work at Telhio. And so I was blessed to be able to come back. And I've been now back for almost 2 years. So that's
Well,
my
all right.
entire
Let's
trajectory.
let's dispel the rumor, the myth, the man, the myth, the legend, that the grass is always greener. So
Yes.
especially, I think we're on an upswing here. We could see signing bonuses start coming back into play for good originators. Why is the grass not always greener? What are the things promised that aren't always delivered?
Yes, that is kind of my entire thing. So I was promised that I was going to be able to, it's like work less, make more because the BIPs are going to be so high. Um, Possibly having a team under me, I was going to be able to get in front of all of these different realtor partners because of relationships that they already had. And I quickly realized that it's not so easy to come by just based on you having to basically be self-employed at some part because you're doing all the work. And so there's not anyone backing you really to help you to get to the next level. And the like 0 times 100 or 120 or 250 is still zero. And so if you're not getting the business and you're not closing the loans, then you're not making any money. And that was what I ran into.
Can you talk categorically about the differences between an IMB and a credit union and why being at a credit union suits you specifically?
For sure. So just based on my last experience, my first 4 years at Telhio, I I love the fact that a credit union is member owned. So the credit union is going to do anything that it can do to provide the best service for our members because they have ownership in the company. And so there's a lot that we can do outside of just like the basic Fannie Freddie to make it work for most people because of the way that the credit union is set up. And we have even like portfolio products and things that we can work with to basically meet anybody's situation. And at an IMB, we're kind of just going off of whatever investors they're working with. And if there's not something that meets those needs, then we're not able to help those clients, or the pricing is insane, or it's hard to get through underwriting because it's like you're working with a different investor, so it's hard to communicate. Like there's so many things that make it trickier when at a credit union it's small and it's local and it makes it, we have a team of two underwriters and I can reach out to them directly. It just makes things a lot more seamless.
This phrase, cultivating comfort or cultivating
Yes.
comfort zone and growth.
Yes.
And I want to know what that means and why it's important to you.
Yeah, so based on my journey and based on realizing that imposter syndrome is a real thing and can exist, and going to these companies and really hoping for the best, and then waking up every day realizing that I am just freaking out. And I was my worst self for the 2 years between leaving the credit union and coming back to the credit union because I just didn't know where I belonged. And so I took this role originally because of somebody else saying, like, you have to get out, and you hear it everywhere. It's like everywhere that you go, every podcast you listen to, get out of your comfort zone, get out of your, like, you're never going to grow if you don't get out of your comfort zone, all the things. And so you hear that, and then you're like, okay, well, then I guess I have to take this new position because that's going to get me out of I'm going to stretch this way. It's going to be amazing. And then doing that, I realized coming back to the credit union, my comfort zone, which I don't like the word comfort zone because I think that has a bad rep. But I think like where I'm going to grow the most is where I'm already rooted. And so within that, I can stretch my comfort zone doesn't have a limit. So it's a very stretchy area. And I'm not saying to get stagnant or complacent within your comfort zone. I'm just saying that you can do your very best work in something that you already know that you're the best at doing. And so coming back and seeing that and realizing that and promoting that, like people started noticing it. I got more referrals once I got back here because I was leading with so much more confidence.
So let's talk about relating that to borrowers in the modern time,
Yeah.
because this sort of getting to the borrower first, engendering loyalty, making sure that you have you're doing the proper outreach to get these, proper inbound stuff is really important right now.
Yeah.
What has worked well for you personally, rather than, oh, I think this should work well, but like what has worked well for you, and kind of, what would you recommend to people for finding their own niche, if you will, for targeting borrowers?
Yeah, for me, what works the best is networking and saying yes and getting involved in as many things as I can get involved in. And so, with the confidence that I have from working at the credit union, then I can go into these different networking groups and get involved and just start promoting what we're able to offer. And so, it's just natural progression of confidence meets networking meets referrals from different sources. And it's also the repeat business that we're getting. But another reason I love a credit union is because people have been members of a credit union for generations. And so they trust the credit union because their family trusts the credit union. So they're coming here expecting us to help them with purchasing a home or refinancing a home because they already have such invested interest in the company as a whole. And so it just makes it easier. And they're trusting us first. So then I'm able to then refer out the business to realtor partners. And then in return, they're going to send me obviously more just because of the referrals that I'm able to send.
What are borrowers focused on right now? Or I guess what's borrower sentiment? Because I would say for a long time it was the rate, the rate, the rate. And I think it's shifted with, maybe it's a little different in Ohio than I'm in California for a
Oh,
good
gotcha.
time more. But it's like insurance premiums are skyrocketing. Property, I was just in Texas for a housing summit. Property taxes are skyrocketing.
Insane.
So I think we've shifted from rate to payment, because rate, an
Yes.
eighth or a quarter makes, 20 or $50 or maybe $80 a month
Yeah.
difference. Property taxes can make hundreds of dollars a month difference, or insurance can make hundreds of dollars a month
Yeah.
difference. So it's like, what are the discussions with borrowers right now? What are they focused on? What's kind of their sentiment? Um, uh, Actually, sentiment should probably be a latter question with the Fed and stuff like that. But what are the discussions that they're having right now?
It is so tricky right now in mortgage lending just because of the way that credit card debt is at an all-time high. Income is lower, it seems, or the debt to income ratio is just so much tighter. And so qualifying people is getting so tricky. And so I do think that while the payment is important and people do focus on that, the rate is still something that comes up on a daily basis. I do think people have gotten more used to rates being what they are today rather than waiting for them to get back down to like 2.875% because I don't think that's going to be happening. It would be amazing, but I don't think that's going to be happening.
No, because and look, I'll put on my capital markets hat here.
Yeah.
Sure, I want lower rates. What do you want to get us there? Another global pandemic? The economy is
Right.
cutting down. Like that's what it would take to get to lower rates.
Right.
I'm glad you brought up rates, though. Let's talk about that.
Yeah.
The conversation shifted away from rate a little bit, but now it's like, hey, the Fed's cutting rates. Rates should come down. It doesn't mean that mortgage rates are going to come down.
It's
No.
not, yeah, it's not tied together. Yeah.
Expectations have already been Fed expectations of Fed rate cuts have already been priced in to current mortgage rates. What are the discussions you're having with your borrowers about rate, and that the nature of predicting the market and things of that nature?
Yeah. So we have our pricing is so competitive because we're a credit union and because we have different partners that we work with and because of, like I said, our portfolio that we're able to utilize as well. So we run all kinds of pricing specials all the time. We have one that's really good right now that puts us in the mid fives. And so that has helped us just,
On a 30
yeah,
year.
30-year fixed for a purchase of a primary residence only. But it's helped us a lot with being able to compete in the market because the average rate is still probably mid sixes. So I think that that has been a big advantage for just working at a credit union is the option to be able to be really competitive in our pricing. But if people are in a rate right now where they would have gotten into like a 7 or an 8% rate when they would have purchased even like last year, they are asking about refinancing, which I am starting. My refinance business is starting to pick up a bit, but more than just a rate and term refinance, a lot of people are doing a cash out refinance because of having a lot of debt. And so consolidating that debt together and making it a more manageable payment has been something that I've seen a lot too.
Then let's talk about where uh, you feel like things are headed from I need to be on top of this as an originator. We see people on social media doing certain things. We see people maybe freed up because of technological advances or AI making the process more efficient to be able to
Yeah.
go out and go to Rotary clubs or open houses or whatever it might be.
Yeah.
I like to go sing karaoke at the Elks Lodge every
Oh,
Tuesday.
yes, I love karaoke.
What's your go-to song?
I think probably like anything 90s, but Shania is always,
Shania
the
is great. All
easiest.
right. If I ever find myself in Ohio, we can do a
Okay, I
Shania.
would love that song. I just like I love a 90s hit of
There,
any
yeah.
sort.
Here we'll go. We'll let people see the real me here. When I drive in my car, I have Sirius XM. It is on Pop Rocks Channel 6 the entire time, which is just like 90s 2000s stuff, like Closing Time by Semisonic,
Yeah, yeah. Like
Saved
any
by a Moment, Lighthouse or whatever. Yeah,
yeah. Do you know Iris? I
yeah.
can't think of the but yeah, that's I really love to sing
Um,
Iris. Yeah, any of those kind of songs.
Yeah,
Yes,
cool.
I'm in.
Anyway, so
Yep.
where do you think things are headed in terms of what the future of an originator looks like? Where do borrowers
Sure.
need them? What are those discussions trending toward? Where, all that.
Sure. Something that I have seen that recently that's been really so eye-opening. I had a person who was buying a home and they were working originally with a different lender. And so they had their loan estimate. And then I presented them because the rate was higher. So then I presented them with our loan estimate. They took both loan estimates and put it into Chat GPT. And then Chat compared both loan estimates and then told them that my loan estimate was the way to go,
Wow.
which I thought was so crazy. But I'm like, if people are utilizing it in that way, then we need to be on top of that because that's going to happen more and more. People are getting like they're using it for mainly everything. I used it to decorate my house. Like it's a really things are coming along. And so I think just being advanced in the technology of what's happening. That's why, so I am just like collaborating with Lender Logics and we use their online tool for pre-approvals. Everything's at our fingertips. And so for buyers and realtors alike, we're just so much more available than where we would have been even a couple of years ago. And I think that that's been like such a game changer too.
Yeah, I do too. Uh, any parting words of wisdom before I let you go today? Anything that's kind of been in your head that you've been thinking about, or open floor?
Yeah, well, thank you so much for having me on this. I think this
Welcome.
is so awesome. And I really just, like I said before, my whole stance right now is grow where you're rooted. You don't have to necessarily create a new comfort zone. You can grow within the comfort zone that you're already in. And credit unions are the way to go as far as mortgage lending is concerned, in my opinion. And I think that that is like the rock that or mountain that I'll stand on through and through, just based on my experience. But I will love the opportunity to be able to discuss this today and any future opportunities to discuss that too.
The grass is greenest where you water it.
Yes,
I've,
amen. Yes, yes, yes.
I've
Fully agree.
learned I've learned that the hard way throughout my life. So, Allie, thank you very
Same.
much for the time. I really appreciate it. I enjoyed this a
My
lot.
pleasure. Thank you so much.
Yesterday saw the U.S. Treasury complete this week's auction slate with an unimpressive 30-year bond sale. And mortgage rates were modestly changed in this week's primary mortgage market survey from Freddie Mac. For the week ending November 13th, the 30-year mortgage rate rose 2 basis points to 6.24%, and the 15-year rate slipped 1 basis point to 5.49%. From a year ago, respective rates are 54 basis points and 50 basis points lower. The October PPI, retail sales, and business inventories reports will not be released today due to the government shutdown. That leaves only remarks from Kansas City Fed President Schmid, Dallas Fed President Logan, and Atlanta Fed President Bostic. We begin the day with agency MBS prices slightly better than yesterday's close, the 2-year yielding 3.56, and the 10-year yielding 4.08 after closing yesterday at 4.11%. Let's wrap up with a joke and some housekeeping. I asked AI to help me prepare my will. When all was said and done, it seems I'm leaving all my money to AI. Thanks again to TransUnion for sponsoring today's podcast. Mortgage lenders choose TransUnion for their identity-focused, data-driven mortgage insights and solutions. enabling them to achieve a more desirable lending outcome or lending outcomes in a volatile housing market. To learn more, visit transunion.com.